I want to share something with you that most people only realize when it's already too late. There's a fundamental difference between building wealth and protecting wealth, and if you don't understand this difference, you're setting yourself up for a devastating fall no matter how much money you accumulate. I've spent decades studying financial behavior, and I've watched countless individuals climb to incredible heights of success only to watch it all disappear in what feels like an instant. The painful truth is that making money is actually the easier part of the equation. What separates those who build lasting prosperity from those who end up starting over is something entirely different. And that's what we're going to explore today. Think about the psychology behind financial decisions for a moment. When people start accumulating wealth, something interesting happens in their minds. They begin to feel invincible. They start believing that the skills that got them to where they are will automatically protect them going forward. But here's where the disconnect happens. The mindset required to generate income is fundamentally different from the mindset required to preserve it. Building wealth often requires aggressive action, calculated risk-taking, and bold moves. Protecting wealth requires the exact opposite. It demands caution, patience, and an almost paranoid awareness of what could go wrong. Most people never make this mental shift, and that's precisely why so many fortunes vanish. Let me paint a picture of what typically happens. Someone builds a successful business or makes smart investments. They watch their net worth climb into the millions. Everything seems to be working perfectly. Then an opportunity presents itself, something that promises even greater returns. The projections look amazing. The potential seems limitless. And because they've been successful up to this point, they feel confident. They feel like they know what they're doing. So they make a decision that concentrates too much of their wealth into one place. Maybe they leverage their existing assets to fund this new venture. Maybe they liquidate their diversified holdings to go all in on something they believe will be the next big thing. And for a while, it might even look brilliant. But then circumstances change. Markets shift. Unexpected challenges emerge. And suddenly, what looked like a path to even greater wealth becomes a trap with no exit. The real tragedy isn't just the financial loss itself, it's the fact that this pattern is entirely preventable. The principles that protect wealth have been understood for generations, yet people continue to ignore them because they prioritize growth over security. They chase returns instead of stability. They focus on what they might gain rather than what they might lose. And this fundamental miscalculation costs them everything they worked so hard to build. What makes this even more frustrating is that the solution isn't complicated. It doesn't require genius-level intelligence or access to secret information. It simply requires discipline and a willingness to accept certain realities about how wealth actually works over the long term. One of the most important concepts to understand is the mathematics of loss and recovery. This is something that sounds basic but has profound implications that most people completely overlook. When you lose a portion of your wealth, the percentage gain required to get back to where you started is always higher than the percentage you lost. If you lose 10%, you need to gain roughly 11% to break even. If you lose 25%, you need to gain 33%. But here's where it gets really serious. If you lose half of your wealth, you need to double what remains just to get back to even. That's a 100% return requirement. And if you lose 75%, you need a 300% gain to recover. These aren't just numbers on a page. They represent years or even decades of your financial life. Every significant loss you take sets you back exponentially further than the original percentage suggests. This mathematical reality should fundamentally change how you think about risk. The deeper the hole you dig, the harder and longer the climb back to the surface becomes. This is why the absolute first priority in wealth management should be avoiding catastrophic losses, not maximizing potential gains. Yet most people approach their finances in exactly the opposite way. They're constantly looking for the next opportunity to grow their money faster, without adequately considering what happens if things don't work out as planned. They treat wealth preservation as something boring or overly conservative, when in reality, it's the only thing that ensures you stay in the game long enough for compound growth to work its magic. So what does intelligent wealth protection actually look like in practice? It starts with a principle that sounds almost too simple to be valuable, but it's one of the most powerful rules you can follow. Never allow so much of your wealth to be concentrated in any single investment or asset that its failure would devastate your overall financial position. This means setting hard limits on concentration regardless of how confident you feel about a particular opportunity. A common guideline that has protected countless investors over time is keeping no more than a quarter of your total net worth in any single position. This isn't about being timid or lacking conviction. It's about acknowledging that you can be wrong. No matter how much research you've done, no matter how certain the opportunity appears, unforeseen circumstances can always emerge. Markets can turn, regulations can change, economic conditions can shift, companies can fail. And if you're overexposed when any of these things happen, you don't just take a hit to one investment, you take a hit to your entire financial foundation. The discipline to maintain this diversification becomes even more challenging when you're experiencing success. When one of your investments is performing exceptionally well, every instinct tells you to lean into it harder. You start thinking about how much more money you could make if you just increased your position. You convince yourself that you've found something special and that normal rules don't apply, but this is exactly when you're most vulnerable. Success can blind you to risk in ways that are incredibly dangerous. The positions that have treated you well in the past are not guaranteed to continue that performance in the future. And concentrating your wealth based on recent results is one of the fastest ways to set yourself up for catastrophic loss. Another critical element of wealth protection is maintaining liquidity. This is probably one of the most underappreciated aspects of financial security. Liquidity means having access to cash or assets that can quickly be converted to cash without significant loss of value. Most people underestimate how important this is because they're focused on putting every available dollar to work in investments that generate returns. They see cash sitting in an account as wasteful because it's not growing at the same rate as their invested capital. But this perspective misses the entire point of why liquidity matters. Liquidity gives you options. It gives you the ability to make decisions from a position of strength rather than desperation. When unexpected expenses arise, when opportunities present themselves, or when markets become unstable, having readily available cash means you can respond strategically instead of being forced into poor decisions. The lack of liquidity is what often transforms a challenging situation into a catastrophic one. When everything you own is tied up in illiquid investments and you suddenly need cash, you're left with terrible choices. You can try to borrow, but that adds debt and ongoing obligations. You can try to sell assets, but if you're forced to sell quickly, you'll almost certainly have to accept unfavorable terms. You lose negotiating power. You lose the ability to wait for better conditions. You become a distressed seller, and everyone who might buy from you knows it. This is how people end up liquidating valuable assets at a fraction of their worth simply because they have no other option. A reasonable approach is to keep somewhere around 20% of your total net worth in highly liquid form. Yes, this might mean that portion earns lower returns in stable market conditions, but what you're purchasing with that opportunity cost is flexibility, security, and the power to act when others cannot. Now let's talk about income structure, because this is where many people who appear wealthy on paper are actually incredibly vulnerable. There's a massive difference between having a high net worth and having dependable cash flow. Net worth is what you own minus what you owe. It's a snapshot of value at a particular moment in time, but cash flow is what actually allows you to live, to weather difficult periods, and to maintain financial stability regardless of what's happening to asset values. Too many people build wealth entirely through appreciation of assets without developing reliable income streams that function independently of their active effort. They own things that they hope will increase in value, but those things don't generate money while they wait. And this creates a fragile situation because if asset values decline, or if they need to access cash, they have to sell something. And selling under pressure, as we discussed, leads to poor outcomes. The truly resilient financial position is one where passive income covers your living expenses. Passive income means money that arrives regularly without requiring your ongoing time and attention. Dividends from investments, rental income from properties, interest from bonds, distributions from businesses you own but don't actively operate, royalties from intellectual property you created. These income sources continue flowing regardless of whether you're working, regardless of your health, regardless of market conditions in any given month. When your passive income exceeds your expenses, you achieve a level of financial security that is fundamentally different from simply having a large net worth. You become nearly immune to financial crisis because even if asset values drop significantly, you're still receiving enough cash to maintain your lifestyle. You can afford to wait out downturns. You can make investment decisions based on long-term value rather than short-term need. You remove the element of desperation from your financial life, and desperation is what destroys wealth. Building toward this goal requires intentional decision-making about the types of assets you acquire. It means evaluating investments not just on their potential for appreciation, but on their ability to generate income. It means sometimes choosing the boring dividend-paying stock over the exciting growth company. It means investing in rental properties even though they require some management. It means building or buying into businesses that produce profit without consuming all of your time. These choices might seem less exciting than chasing the next big thing, but they create the foundation of lasting financial security. And here's something that might challenge conventional thinking. The actual market value of your income-producing assets becomes far less important when you're focused on the income they generate. If you own an investment that pays you $50,000 annually and the market value of that investment drops by 30%, have you actually lost anything meaningful if you weren't planning to sell? The income continues. The cash keeps arriving. The paper loss is irrelevant unless you're forced to liquidate. This mindset shift, from focusing on asset prices to focusing on income production, is one of the most powerful moves you can make toward building anti-fragile wealth. Let's address another uncomfortable truth about wealth protection. You need to operate under the assumption that you're wrong about everything. This isn't about lacking confidence or being pessimistic. It's about intellectual humility and realistic planning. Every investment thesis you develop is based on assumptions about the future. You assume certain economic conditions will persist. You assume certain trends will continue. You assume certain outcomes are likely. But the future is inherently uncertain, and your assumptions, no matter how well researched, could be incorrect. The question isn't whether you'll be wrong sometimes. The question is what happens to your wealth when you are wrong. If your entire financial structure depends on a particular scenario playing out and that scenario doesn't happen, you're in serious trouble. But if you've built your wealth to survive multiple different scenarios, being wrong about any one of them doesn't matter. This is why genuine diversification goes beyond simply owning different assets. It means diversifying across different assumptions about the future. Some of your wealth should be positioned for economic growth. Some should be positioned for economic stagnation. Some should be positioned for inflation. Some should be positioned for deflation. Some should be in assets that perform well when markets are rising. Some should be in assets that hold value when markets are falling. This isn't about trying to predict which scenario will actually unfold. It's about ensuring that no matter what happens, some portion of your wealth is positioned correctly for those conditions. You're building a portfolio that doesn't depend on you being right about the future. It depends only on you not being catastrophically wrong about everything at once. The final piece of the wealth protection puzzle is preparation. Most people are reactive with their finances. They wait until something goes wrong and then try to figure out how to respond. But by that point, their options are limited and the damage is often already done. The alternative is to spend time thinking through potential problems before they occur and putting protective measures in place while things are still going well. This means maintaining adequate insurance coverage across all areas of risk: life insurance to protect your family's financial future, disability insurance to protect your income if you can't work, liability insurance to protect your assets from lawsuits, property insurance to protect your real estate investments, health insurance to protect against medical costs that could otherwise be financially devastating. Insurance feels like an expense that you hope never to use, but it's actually a tool for capping your downside risk. It ensures that even if something terrible happens, the financial impact is limited and manageable. Preparation also means maintaining emergency reserves beyond your general liquidity position. Having enough cash set aside to cover at least 1 year of living expenses, ideally 2 years, gives you an enormous psychological and practical advantage. If every source of income were to stop tomorrow, you'd have time to assess the situation calmly and make good decisions without panic. You wouldn't be forced into immediate action that might be detrimental long-term. This breathing room is invaluable, yet most people never create it because they're too focused on deploying capital for growth. And preparation means building redundancy into your financial life. Multiple income streams so that if one fails, others continue. Multiple asset classes so that if one sector crashes, others provide stability. Proper legal structures so that if one entity faces problems, your other assets remain protected. This redundancy costs money and reduces efficiency in the short term, but it prevents total failure. And preventing total failure is worth more over a lifetime than maximizing efficiency, because you only need to fail catastrophically once for your entire wealth journey to end. When you put all of these principles together, something remarkable happens. You stop feeling anxious about your finances. You stop obsessing over market movements. You stop losing sleep during volatile periods, not because you don't care about your wealth, but because you've built a system that can handle whatever comes. You've created so many layers of protection, so much redundancy, so much preparation, that no single event can destroy you. Your wealth becomes resilient in a way that most people's wealth simply isn't. And this resilience gives you a massive advantage because you can make decisions from a position of strength. You can wait for truly exceptional opportunities instead of feeling pressure to act on mediocre ones. You can think in decades rather than quarters. You can say no to things that don't meet your standards without fear of missing out. You can be patient when everyone else is panicking, and you can be aggressive when everyone else is fearful. This is how generational wealth is actually built. Not through spectacular wins or genius predictions, but through systematic protection and patient accumulation over extremely long time periods. The people who build wealth that lasts through market crashes, recessions, personal setbacks, and every other challenge that life throws at them are the ones who prioritize survival over growth. They understand that staying in the game is more important than winning any particular round. They accept lower returns in exchange for higher certainty. They give up some upside to eliminate catastrophic downside. And over the course of decades, this approach compounds into extraordinary results because they never have to start over. They never experience the devastating losses that set others back years or decades. They just keep steadily building, protected by principles that have worked for centuries. So here's what I want you to do. Take an honest look at your current financial situation and ask yourself some difficult questions. How much of your wealth is concentrated in your single largest position? If that position failed tomorrow, what would happen to your overall financial security? How many months of expenses could you cover with cash you can access immediately? What percentage of your monthly costs are covered by income that doesn't require your active work? What assumptions is your current financial plan based on, and what would happen if those assumptions turned out to be wrong? What risks are you not prepared for, and what would the consequences be if those risks materialized tomorrow? These questions will reveal where your wealth is vulnerable, and once you see the vulnerabilities clearly, you can address them. You might need to reduce concentrated positions even though it feels uncomfortable. You might need to build cash reserves even though it means selling some investments. You might need to shift toward income-producing assets even though they seem less exciting. You might need to purchase insurance coverage you've been avoiding. Whatever the gaps are, fix them now while you have the ability to do so calmly and strategically. The most expensive lessons in finance are the ones you learn from your own mistakes. Losing wealth that took years to build because you didn't understand or implement basic protection principles is a tragedy that doesn't have to happen. You can learn from the patterns that have destroyed others and make different choices. You can build wealth that survives anything. You can create security that protects not just you, but everyone who depends on you. The principles are simple. The execution requires discipline, but the result is worth it. Financial security that allows you to sleep well at night, make decisions without desperation, and build something that lasts far beyond your own lifetime. If you found value in this analysis, do me a favor and hit that like button. Drop a comment below sharing which of these principles resonated most with you, or what financial topic you'd like me to cover next. And if you haven't already, subscribe to the channel because I'm committed to creating content that helps you build real, lasting financial understanding without the hype or nonsense you find elsewhere. Thanks for watching, and I'll see you in the next one.